The stock market just had one of its most dramatic earnings weeks of the year. Big tech giants have already set the stage. Meta, Microsoft, and Alphabet made their moves, and the spotlight is now on Amazon, Apple, Coinbase, and Reddit. Volatility is everywhere, but in times like these, opportunities often hide in plain sight. Welcome to Finance Flicks Hub, your space, for smart insights, clear analysis, and powerful investing ideas. Today we're breaking down 5 standout stocks that could be worth a closer look right now. Some are bouncing off major lows, while others are preparing for their next big move. So grab your notes, let's dive in. 1. Meta Platforms, Meta. Meta had one of the most misunderstood earnings reports this quarter. The company's stock dropped nearly 13%, and many investors panicked. But here's the truth. Their GAAP EPS came in at 15s, missing expectations by 566, but that miss was due to a one-time non-cash tax charge, not an operational issue. In fact, their revenue jumped 26% year-over-year to $51.24 billion, beating estimates by $2 billion. Ad impressions grew 14%, showing that Meta's advertising machine is still extremely strong. The sell-off came mainly because Wall Street focused on short-term expenses, like higher AI investments and losses in reality labs, instead of the long-term potential. Here's what matters. Meta remains one of the most profitable companies in the world, with an incredible 82% gross margin and nearly $1 million in net income per employee. After the dip, the stock looks attractive around the $670 range, and technically it's still supported near its 200-day moving average. If the market remains healthy, Meta could easily aim for $801,000 again. 2. Rubrik, RBRK. Rubrik might not be a household name yet, but it's quietly becoming a major player in cybersecurity and AI-driven data protection. The company helps businesses protect and recover their data from ransomware attacks across platforms like AWS, Azure, Google Cloud, and Salesforce. Think of Rubrik as the safety vault for the digital world. Their growth story is strong. In 96% recurring revenue, 36% annual recurring revenue growth. Positive free cash flow of $57 million. They've been ranked number 1 by Gartner for 6 years straight for their data backup solutions, and they've even partnered with Cognizant to offer business resilience as a service. Now, it's not all perfect. The company isn't GAAP profitable yet, and the valuation is still high for a young stock. But that's, typical for high-growth tech names. For long-term investors, the ideal buy zone looks attractive below $75, and even better between $68.57. If cybersecurity continues to grow, and it will, Rubrik could quietly become one of the next big tech stories. 3. Chipotle, CMG. Chipotle's story right now is about timing and patience. Their target customers, mostly young adults between 25 and 35, are facing a tough economy. Higher unemployment, student loans, and slower wage growth have all hit consumer spending. In the latest quarter, revenue came in at $3 billion, up 7.5%. Comparable sales grew, 3% EPS was 29s, matching expectations. But the operating margin slipped to 15.9% and the stock dropped 17%. Despite that, Chipotle is still expanding aggressively. They plan to open 350 to 370 new restaurants by 2026 and are introducing automation to improve speed and reduce costs. Yes, the valuation remains high, around a 34 PE, but after a 45% drop from the highs, it's approaching an attractive zone near $32. For patient investors, that's where Chipotle starts to look like a long-term value play again. 4. Cava. Cava is the new kid on the block, a fresh, fast-growing restaurant brand that's being called the next Chipotle. The stock went public in 2023 and saw an incredible run from $30 to $172, but since then, it has cooled down and now trades under $55. Here's the exciting part. Growth remains strong. Revenue is still climbing 25 to 28% year over year, and the company continues to open new locations across the US. Yes, it's expensive, with a price-to-sales ratio around 6 and a forward PE above 100. But that's normal for early-stage growth names. If Cava keeps executing and expanding like Chipotle did in its early years, Today's dip could be tomorrow's opportunity. Technically, the 50-55 zone looks like a solid accumulation area. 5. Netflix, NFLX. Netflix has matured into one of the most consistent growth stocks in the market. It's profitable, it's innovative, and it keeps finding ways to grow even in a competitive streaming space. With a 48% profit margin and $745,000 in net income per employee, Netflix is running one of the most efficient operations in tech. The stock is up 44% over the past year and 23% year-to-date. While it doesn't pay a dividend, it continues to reinvest heavily in content and international expansion. Right now, the price hovers around $100, slightly below its 200-day moving average. If the market weakens, anything below $1,000 could be a great long-term entry point. Conclusion. Earnings season can be chaotic, but that's exactly when opportunities appear. Instead of reacting to headlines, smart investors look beneath the surface. Here's what this week shows us. Meta, punished unfairly for an accounting charge Rubrik, quietly powering the future of data security Chipotle, strong brand, temporarily slowed by the economy Kava, fast-growing newcomer with early-stage potential Netflix, steady, proven, and still growing. Each of these stocks represents a different type of opportunity, from undervalued tech to high-growth consumer plays. And that wraps up today's breakdown of 5 stocks to watch after a massive earnings week. Thanks so much for watching. Your time and attention mean a lot. If you found this helpful, make sure to subscribe to Finance Flicks Hub for more weekly insights, market breakdowns, and smart investing ideas. Stay informed, stay patient, and remember, volatility creates opportunity. See you in the next one.